Good day, everyone. Thank you for joining us once again here at Seafried and Brew for our weekly briefing. I am Jamie Sumner, Chief Analyst, and for this week's briefing, we want to review over the Fed statement and projections that came out last week. And then we're going to look at some of the forward curves and talk a little bit about deposit rates and how they've been changing. So when we look at the statement that had come out, no real big surprise in what they've said. We kind of anticipated some of these numbers with the information that has been coming out. Overall, the labor market has continued to strengthen. We continue to see the number of jobs being produced and the overall unemployment rate staying where it is, but that's the case because of the overwhelming number of individuals entering the job market, increasing that overall participation rate. So that's a positive, and it continues to strengthen. And then we see where they say in terms of the economy that it continues to grow, but the rates of the household spending and business fixed investments, they say, have moderated. And that's an important point that we have to take into consideration because we saw in the fourth quarter numbers, in the fourth quarter GDP, that those items really boosted that fourth quarter GDP. And now we're starting to see that pull off. Our hope is, though, that we'll begin to see the reinvestment in that business sense with the tax cuts, and that should spur on those capital investments for those businesses. That is what we're hoping to see coming either in the second quarter into the third quarter and then the rest of the year. As far as inflation goes, no real big surprise. Inflation still moderated. In fact, they continue to say that the inflation compensation has increased, which it has, but very modestly, but it remains low. And it's the continual story that we have is this inflation, particularly in the wage inflation, just really hasn't moved the needle all that much. But overall, the expectation for inflation is still balanced and relatively low. So overall, no real big surprise. They did, however, increase the overall Fed funds rate, and that was as expected. But with this release, they also came out with their projections. If we recall, they do these projections 4 times a year. So we get to see what they're thinking about the future and how they've changed from where we were in the last projection. So overall GDP, they increased both 2018 and 19 assumptions here or projections. They're up to a 2.7% GDP in 2018 and 2.4 in 2019. Now, granted, they are faster growth than we've seen previously in their projections. However, they're still not at the point where we can deal with the overwhelming amount of debt we have as a nation. With a debt to GDP ratio above 100%, we need to grow 3 to 3.5% in order to whittle away at that debt. And we're still not seeing that growth. The median here for GDP in 2018 at 2.7%. That is very similar, that is exactly the same, in fact, as that projection of the IMF when they came out in January. So we're starting to see convergence in the assumptions. But then in 2019, 2020, and then their long run, they continue to step down. 2.4 in 2019, 2% in 2020, and then a long run at 1.8%. So we still don't see that long-term growth prospect in here or continuing that growth trend. We continue to grow slower and slower. To me, that's a concern because we do have this debt that we have to deal with. Unemployment rate, they say, it's going to come down to an expected 3.8% in 2018 and then 3.6% in 2019 and stay where that is in 2020. So we continue to see this tightening of the labor market, which should anticipate, if that happens, to see that wage inflation. But when they look at inflation, we can see inflation in 2018 at 1.9%, no change from their December projection, and the inflation in 19 and 20 looking at 2.1%, so going just above their 2% target. So we can see that, and that would necessitate them raising rates faster. And that's what they said. They kept 2018 the same, 2.1 for their Fed funds by year end. That would give us 2 more in addition to the one they just did, 2 more rate hikes. And then 2019, it seems like they added a rate hike as well as in 2020. So we see these continual increases in the rate hikes. Maybe a little more hawkish on the long end, but we'll have to wait until we get there to see if that's going to, in fact, be the case. They are very data dependent, as they say. So as these economic numbers continue to come out, it'll give us a little clearer picture in terms of where those rates are going. But overall, when we look at the market for the Fed funds, the probability still lies with those 2 more rate hikes. You can see 1 more here out in June at their June meeting, and then we see out in September another rate hike. That probability is at 42.6 right now. So it's still not overwhelming, but there is a higher probability of that rate hike than no rate hike in that September timeframe. But we'll continue to review this as the year goes along and see if we begin to see a 4th rate hike coming in here. I don't see the need for the 4th rate hike unless we begin to see this wage inflation really pick up in here. But as I'm looking at the numbers, I don't really see that need. In fact, I don't see the need for 2 more rate hikes, but I think the Fed will follow through in what they're projecting. So from there, we can look at the overall Treasury curve and the forward rates. And as you can see, we've seen this chart before. This is the spot curve as of the 23rd, March 23rd, and then the 12-month, 24-month, and 36-month forward curves. And you can see that we continue to get flatter and flatter in here, and then out 36 months, really flat. And if we look at the 10-year versus the 2-year, we're off by just 15 basis points. So very, very flat out 3 years. And that has an implication on our asset pricing and our liability pricing. And we've seen pretty much of an upswing in the short end of the curve since 2015 when the Fed started tightening. And we continue to see that happening in here. The long end really not moving all that much. We're up on the 10-year though when we look year over year, but the movement isn't nearly as much as we saw in the short end. So we have to talk about interest rates on our deposits, because this is where banks are going to struggle, I believe, this year. As we progress through the year, I think the need to increase those rates is going to be heightened. We already see this happening on CD rates. We have S&L average CD rates on this side here, and we can say these are the rates that are posted in the branches. These are the renewal rates. We have the 1-year right now at 0.67, and then we have the 2-year at 0.94. So when we look at that and the changes from where they were a year ago, not real big changes, 20 basis points, 30 basis points, fairly small changes. This is from 2 years ago, in fact, back in 2016. When we look at the bank rate numbers, these are the specials that are out there. You can see the average, the national average 1-year rate at a 141. You see that disparity between the renewal rate of 0.67 and the national average 1-year rate of 1.41. So these are the specials that are out there. And then we have the best rate at 1.6. That was as of August 2017. When we come to today, we have the national average at 1.89 1.96. So 1.96 compared to where we were back in August at 141. That's a 55 basis point increase. So we saw this up in interest rates in the second half of last year. And that primarily occurred in the CDs. Now we start to see this starting to happen in the cash type deposits. And this is where banks have really lagged in terms of increasing deposits. And we see this going over the past couple of years. You can see where we were on, let's pick out the mid-tier money market. We were at 16 basis points as of December 15th, 2015, the day of the first rate hike. In the end of 2016, we saw that go to 0.21, up just 1 basis points. At the end of the year 2017, we were at 24 basis points. And then now, as of 3/20/2018, we're at 26 basis points. So these are the average rates. When we look at the national high, though, we can see back in 2015, we were at a 131 on the mid-tier money market. The end of last year, we were at 150, and now we have ourselves in the high number at 2%. So we start to see this increase in these changes in these deposit rates, these cash type deposits. And this is a very important and a very sensitive subject to institutions, because we've grown in the number of deposits that pertain to cash type deposit to in excess of 70%. So when we start changing these rates, it has a bigger impact on our bottom line. In fact, when you are looking at our ALM, the one thing we might want to do this year is thinking about a fairly stressed situation in terms of everything else stays the same except those cash type deposits. And we increase the overall cash type deposits throughout the year. So one way to look at this is to look at your overall net interest income as if everything else kept the same, but interest rates on your cash type deposits or your deposits in general have increased. And an easy back of the envelope way of doing this is just to take your interest income, okay, and then at the base or rates unchanged, and you subtract out your interest expense in the plus 100 scenario. And this would give you your net interest income if everything else stayed the same except your liabilities or your funding prices increased. And in fact, if you want to look at this a little more sensitive just to deposits, you just use the plus 100 on your deposit interest expense and keep your funding expense the same. Now we want to do this because this will give us an indication is if rates do not change at all, so base case, no rate change, but the depositors are forcing us to increase their deposit rates. And that could be either depositor-led from our banking customers, or the need to increase rates because the market in general for deposit rates have increased. And we need to retain those deposits, so we need to increase our institutions' deposit rates. So that's one way to look at it. Back of the envelope shows your sensitivity in that scenario. And it's important to know that because I do believe over the next year, we're going to go through this process of now finally having to reprice those core cash type deposits. So that's what we have for you this week. We look forward to talking to you next week as we explore different topics in the economy and in the rates. Have a great week, everyone.